Hey everybody, this is Danish from TYK Trade, and you are listening to one more episode of Trader Talk, the show that gives entertaining blend of professional insight and inspiring stories from professional traders for people who love technical trading. Today, we would be reviewing the NASDAQ and S&P 500 charts with Javed. Javed, as we all know, has experience of more than 25 years uh, trading stocks. Um, and he's been working on Wall Street for almost 24 plus years now. So today we will be doing chart review for major indices, NASDAQ and S&P 500 primarily. So Javed, uh, would you like to start your screen sharing?
Yeah, share my screen. I have my charts up. Okay. You see my chart.
Yes.
All right, so this is what I think. I think, like back in the olden days, we used to draw the long-term channels. So I drew a couple of long-term channels here. Starting for when the pandemic. Let's talk about the good times first. So when the pandemic started, I drew a long-term channel that basically encompasses the bottom and top of the pandemic crash on the NASDAQ. And it goes to this high of September, which we all remember.
Yep.
And then
consolidation.
And I connected it to appear in March of last year, March 2021. But then I started a new slope at that point in September. After the September sell-off, I started a new channel with a new slope, which is slightly less steep. Not as steep as this. I mean, it's similar, but not as steep. And then that channel would last all the way to the all-time high of 16,767. So only two channels for the entire pandemic until the all-time high. Then I have it as flat right here. Here's a box, double top, classic double top. Coil box right here, a W top. And then I think that the whole sell-off this year, from the beginning of the year, we didn't even get a break. It's like the first day of the year down, has been largely, you could say, one wide channel with this pink all the way up to the white right here. You could say that was one wide channel, or you could say it was two channels. So we had this blue line to the pink line, which is one channel, and then similar width, almost same width, the blue line to the white line here was the second channel. Interestingly, the bottoms of this new channel are hitting the tops of the old channel. So this blue line was the tops of the old channel, first channel, and now that's setting the bottoms of this new channel. I also think within this new channel, we have a line that's splitting it, this gray line right here. So again, the tops of this new channel here, this white and blue channel, the tops of this channel are split by this kind of 45-degree line. And now the bottoms of the upper half of this channel are hitting that split line right there. So before the split line was the tops of the candles, tops of the downtrend line. And now if you take this new downtrend line, this top of this channel, it's forming the bottoms. So the same resistance is now new support. So similarly, like this blue line was the resistance and became support right here.
Mm-hmm.
It was resistance over here for the first half and then support. Now, if you take this new channel and split it down the middle, these resistance hitting the same line that becomes support right here. So I like to simplify long-term periods. 3 years was largely 3 channels. Channel 1, channel 2. Can I type? I think I can type. Channel 1. No, that didn't work.
You will have to use annotation.
Annotation, right?
Yeah, you have your text. You have your text thing. T right
Here?
there.
This one?
Uh,
Text note?
text note. Yeah.
Is that it?
I cannot see. Hold on.
No, I don't know. That's okay.
I don't know what you're saying. 1,
1,
2,
3.
and 3. Do you mind if I show you something of that I have?
Yeah, go ahead.
Slightly different from yours, but pretty much on the same spirit. If you can
Okay.
stop your sharing.
Yeah. Oh, I stopped mine. Hold on. Okay.
So this is what I see.
Yeah, it's exactly the same.
So you made 3, but in my chart, I see like this was one big bull run. So
I like that. That's even cleaner. I like
here
that.
it was hit. So here it was pushing against the top of the channel. Then it came to, so the green 3 lines in the center is the mean of this channel, if you will. And it was pushing to the top and it came back to the bottom, like center, gravitated towards the mean line. And then
That's a nice way of thinking of it. Yeah.
and it kept on tagging onto this mean line for the longest time, and that we can see. And suddenly it hit this resistance.
What do you call that drawing tool?
This is called as Fibonacci channel here in TradingView.
Fib channel?
Fib channel.
Okay.
So what I did was, if you notice, I took this top here, this bottom here, and this top here, and it automatically created a channel. Now, this looks like scary in the sense that the candles kind of respect these lines. They just stick onto these lines like they have to believe in these lines. And hence, like this was an upward channel. This looks like a downward channel.
Do they have the same width, both your channels?
I can measure that. So if I were to measure the, sorry, not this. The width of this channel is 2600 points. And the width of this channel here is,
Yeah, do a 90 degree. Yeah. That's about, yeah.
2200 points.
2200 versus 2600. Okay. Similar.
Similar, not exactly the same, but yeah.
But they're consistently that
pretty
high.
consistent. They're pretty consistent. So this kind of gives me the general trend. So last week I said this might be a breakout or a fake out. And I said if it is breaking up, it has to break the previous high to be considered as a breakout.
Yeah,
Else
I agree.
it may fail at the previous low and it will be a fake out.
Yep.
So this looks like an eerie picture.
And if you look to the left, we're in that congestion zone. The way you've drawn it.
We
makes it
are
all
here. We are right here
Yeah.
in this box.
congestion zone, yeah, and which makes sense, right? That was one of the only congestion zones we really have, where we have some serious belt hold candles that hold us up. That green candle, the red candle. So those are like some serious, buying and selling pressure, which is causing us to hold up over here right now. Yeah,
This is exactly that zone that we are in.
exactly. We're fighting that box right there. Where
That's
a lot
right.
of people, that was the first time in the pandemic that we slowed down. We all remember that September sell-off.
Yeah.
We all had to wait like 4 weeks to make our money back, 6 weeks. So that is, and that's the market memory right there. And that was kind of like what people like to call the bear market rally right there, which was like the rally in between the two downtrends, right? There's one
Yeah.
downtrend, another downtrend. That's where that rally happened. Those 3 green candles on the right.
That's right.
So
this
both
box held up here. This box is holding up here. I don't know if it will hold up and push through this box on the top, or it goes all the way up, touches this guy, and bam.
Or go sideways, right?
Or go sideways.
That was a lot of sideways back then.
It might actually get stuck in this zone.
Yeah.
And we may see a U-shaped recovery as well.
Yeah, exactly. Could be a lot of sideways this whole summer. Low volume.
In fact, I was discussing it with somebody just yesterday, and this is what I was saying. This may be
Yep.
one giant of a cup.
Yep. I like that right there. Yep.
And then we will get into trouble again and form a handle.
Yeah, agreed.
Like this.
Or we don't make it all the way to the top and you make it to the other neckline, which was like April 2022. So you can even lower the neckline to what we had in April of 2022.
This one right here.
Yeah, you could lower it to that and put the neckline there and put a handle down there too.
Oh yeah, this is also very possible.
Yeah. Because there's a whole box up there we got to fight, right? That double top box.
That's right. It's not going to be linear, obviously.
So it might be like, let's hold up before we get there and just go to the first neckline and consolidate again.
You may see this.
Yes, exactly. Let us fight for it a little longer. Yeah.
And then it may
and a measured move. Yeah, measured move off that cup handle,
Cup and handle, right?
Yeah. And that might be a perfect measured move to get to the top too. Or Danish, we go sideways in a box up and down in this box up to that first neckline.
In these two things, in between this band.
Live in that band somehow.
And this may become longer.
Yeah, because it takes us a long time for companies to right size, and
you're right.
Their earnings higher, or multiples to expand, or both. Right? Multiples expansion from, less fear of risk or rate curve flattening, or companies just have to keep increasing their earnings, but the multiples stay low, right? Stocks can still go higher in that equation, right?
Yeah.
Multiples are low for many years, but earnings keep going up because, even in an absent a great revenue growth environment, earnings keep going up because they keep buying their shares, right? So earnings per share keeps going up.
That's right.
Because their best investment is their own stock, right? Because they don't have positive IRR, positive return projects, right? So keep buying their stock, keep getting their earnings higher, blocking and tackling, and multiples stay low because there's still a lot of fear, a lot of disinterest. But then stocks move higher, or flat until.
In that case, it would See, something similar like this happened in 2018.
Yeah, show us how long we went sideways in 18. That would be great. And how wide that band was. That was a super wide band. Yeah. Or even expand that 18 to 19. Yeah. So you'll see this little one and then draw a bigger box after
That
that.
is, I'm making it. I'm making it. I'm getting there.
And then make the smaller box again. So small box, big box. Yeah, these are two small boxes. Exactly. And then there's like a widening in the middle, right?
Yeah. This is just one big
That's what
consolidation.
we were all doing before the pandemic, quote unquote, saved us and gave us a catalyst to move higher.
So if I go to
Catalyst
monthly
to
chart,
more liquidity.
this is a one big box
Yeah,
right here.
all three of them are one big box. Yeah,
Yes.
exactly. Yeah. I mean, you could put the middle box. Yeah, just draw the middle box. It's fine. Yeah. And all three of them kind of form a bigger box. Yes, exactly. One small box, big box, small box. And I wouldn't be surprised. How long did that take?
Oh, this went on from December 17 to October 19, 2 years.
Yeah. And that's normal. That's normal where you wind up like that for 2 years and not really get very far. That's very normal. But that's an awesome environment for a lot of people to play it. Because you're not getting out of hand, you're not having too much liquidity out there. That's healthy growth. So I wouldn't be surprised if we had 2 years of largely flat to get back to the top. That wouldn't be surprising at all. And then, that would be more sustainable.
This is one big giant consolidation.
Exactly. And if you go back before that, Danish, you could draw the same.
This one.
Yeah, you could draw it right there, 15. This is Operation Twist, by the way. Like in 15, 14 to 15, you could say 15 was largely sideways too, for a good part of it. Yeah. Is the middle of
Starting
that
the
box.
beginning of 15th,
Yeah.
2015, February, all the way to the end of November 16, 2 years.
So do a Google on Operation Twist, and let's see what dates come up there. Operation Twist was when the Fed had to unwind. They tried to unwind unsuccessfully. Yeah, what dates you have there? Okay.
It's not giving the dates.
Okay, put date in the Google search.
Yeah.
But then when's the second time? So earlier than what I'm saying. I thought it was 14 to 15.
No, this was European banks doing the.
Oh, what about the Fed? I want the Fed's Operation Twist.
This is 11, 12. Fed did it in 11 and 12. European banks did it in 2015, 16. From what I remember from my memory.
Here, look, see? The Fed ended its quantitative easing policy in October 14.
Yeah.
Okay. So that's when the Fed wanted to unwind. And so that's when the market got hit, right? Liquidity came down. So Fed's trying to unwind the balance sheet now, and we're seeing liquidity hit as well.
So they ended.
Go ahead.
They ended in October 14th.
Yep.
2014, and this all went.
Look, you can even make a case for sideways even starting in October. Hold that mouse back there again. Yeah, you could say we went sideways after that.
Yeah, of course. It's still the same box.
Yeah, you could say the box is right there. Yeah. So same box. Yeah,
Same
there you
box.
go. Yeah. So that was forming the top, right? The resistance right there.
This was the floor of the box.
Yeah. So then we had a sideways after that for how long, right? 2
2
years.
years.
But that would make a lot of sense to go sideways for like 2 years. Sideways 2 years would be healthy if we can pull that off.
812 days, more than 2 years.
Yeah.
Wow.
2 years sideways is actually a great situation because the market's not continuously crashing. So it's not indicating that the economy is necessarily falling apart, but it's just struggling to make way, which would, keep inflation, help the Fed in its inflation fight, and help the Fed in not overheating the economy. So if the Fed can aggressively hike rates into a sideways market for 2 years and lift the yield curve, then, because remember, I used to say all money comes here because we have the returns. Now, interestingly, if all money, let's say the dollar is soaring, we used to think about this in crude all the time. If the dollar's soaring, but the theoretical value, the intrinsic value, I want to say, of the market of companies is the same, then in dollar terms, the nominal price of companies has to go down. So let me say that again. If you have a stronger dollar today, it's worth more, it buys more, then the price of all companies should go down.
Come down. Yeah.
Nominal, if they're intrinsically worth the same on an earnings basis, right?
Yeah.
We're seeing a tremendously strong dollar, record highs, almost parity with the euro. So that's putting a tremendous amount of pressure on the nominal price of the market. The market's actually worth a lot more. It's just
because the dollar is getting stronger. That's also one of the reasons. Yes.
And we're pricing the market in dollars, obviously. All prices in the US for the market are dollars. So you're using a stronger dollar to buy the same market. It's got to be priced lower, which it is.
Yep.
How much did the dollar appreciate, Danish?
Let me check it out.
Last, since this crash, since January, let's say. USD euro would be good. Yep.
Ooh.
Yeah, tremendous. So let's see what that is. Euro USD. Oh yeah, let's do it this way. This is better. Okay. So
18%.
18%. And how much did the S&P go down, coincidentally?
24.
There you go. Right?
Yeah.
So is it 24? What's today's value? Yeah.
Well, the lowest point it was 23.5, 24-ish.
Okay,
right now it's 20%.
Okay, 20 versus 18, right?
Yeah.
So there you go. It's okay. So it hasn't gone anywhere, right, Donnie?
Yeah.
If you cancel out the FX effect, it has.
Well, if I were to check out from, so this is from the bottom from May 2021, but if I were to check it out from January, it's not as much. It will be lesser than that. 10%.
Okay. So you can take 10% of the move as currency and then 10% valuation drop. But 10% is a normal.
And that's normal. That's normal.
Yeah.
That's very normal.
So in intrinsic terms, it's only down by 10% if you take out the currency effect.
Yeah.
So not too bad. I mean, the good thing about looking at charts this way in a longer term chart is it lets you zoom out and avoid the noise.
And that's why I'm looking just at weekly charts, weekly and monthlies.
Weeklies are great, weeklies and monthlies. And the thing is, we're trend traders, but trend traders would have a hard time if trends didn't last a long time.
Yeah.
And we're looking at 2-year trend. Everything we did today was 2-year trends, right?
Yeah.
So 2 years of up, 6 months of down, and then previously you showed 2-year box right there. That's a great chart that you drew.
This is
and
one
then 2
box.
years
This is
before
another
that,
box.
there's another 2 years, right?
Yeah.
2015 to 17,
So
basically.
there is one box right here, 14 to 16,
That's 2 years.
2
right
years.
there.
And then there is this one big box, 17 to 19.
There you go. 2-year consolidations.
Yeah.
You know, and maybe we're going through a 2-year consolidation now. It's just a lot steeper, right? So you could draw a big box sideways here and say it's largely 2 years, right? Let's say we make it back to the top of this box. Then this box started after September 2020, right? You could draw a zigzag saying it started in September 2020, hit the top of the box at the all-time high. Yes, sir, right there. And that's a solid 2-year cycle right there.
Big fat box.
There you go. September to September. This September will be 2 years, right? September 2022 will be 2 years.
Yeah. So for this to complete, it'll go all the way up to 2024.
There you go. Right?
And it comes in the monthly chart.
So that makes a lot of sense. 2 years and then another 2 years is a really wide pandemic consolidation.
It looks actually, this actually looks like this.
Yeah, same thing, right?
So we come down the bottom, go back up, consolidate here, and then move on.
And then move on. Exactly. Get out of this mess.
And consolidation is not bad.
No, you can tell very healthy. It's the only way.
Actually, it's actually required. The reason we're coming down is because we did not have any consolidation here.
Yeah, we didn't digest our gains, right?
We did not digest it.
Yeah, we need to digest. Market needs to digest, just like human body. It needs to digest the growth.
Yeah.
So I like sideways. You know, sideways creates a lot of opportunity. First of all, creates a lot of opportunity to swing trade. If you want to swing it in the box and you have a firm understanding of the box, you can sell premium the whole way through. You know, you can dollar cost average if you have more capital, or if you're selling premium, you could use your premium to dollar cost average and buy more shares. So there's a lot of ways to play a box when you're comfortable with where the box is. So you could do a combination of everything I said.
I actually made an arbitrary blue line, and it seems like it's kind of sticking onto this line for now.
Yeah, I like that. I like that. I believe, honestly, Danish, that we're always tracking necklines on these rounded bottoms, V bottoms, W bottoms. The reason I believe this is pure supply demand. So if you can take your mouse, you don't have to draw, just follow with your mouse from the top of your blue line down to the bottom of the vertex. I believe that that is actual facts because it shows the machines where the supply was. Everybody lost money and supplied shares to the market, you know, or it was previous demand, right? So maybe it's better to say, that was previous demand. Everybody bought and lost money all the way to the neckline. Everybody bought and lost money all the way down. Yeah. Now everybody's a loser because we're hitting record lows here for the last couple of years, right? Last 2 years. Now everybody's a loser. The machines realize that all these people have bought, they own shares, and they've lost money on those shares. So the machines on the way up will follow it to the neckline because they know as demand, the machines are demand coming off the bottom. So as the machines demand more supply of shares to eat, to buy, they know that all of these bars up to the neckline, the top of your blue line is the neckline. They know that they're available for sale. That's guaranteed. After that, they don't know. And we always get a handle, right?
Yeah.
Because they don't know what will happen when we're in uncharted territory. But they do know that all these shares are potentially available on the way up as they demand more shares. That's why I always believe we are looking for necklines, machines, because they are demanding the supply that they know is already there. I totally believe the necklines play out.
It always follows the tops and bottoms.
Exactly. Exactly. We look for necklines on the bottom on the way down, as we have been on the downtrend. And we look for necklines at the top on the way back up. So yeah, you could flip this neckline outlook and say, yes, we were looking, and that's what you've been waiting for, which is totally healthy, which is when can we have a neckline that will hold?
Yeah.
Because I also believe when we cannot get the measured move after hitting the neckline, that's when we have a trend reversals. And that's what you are looking for. You're looking for a retest.
It has to go up,
Yeah.
hold over here, come back,
Yes.
or hold over here, go back up a little bit, come back right here.
Yes.
And then the next time it moves up is something I would say, yeah, now we have hit the bottom.
We need that higher low.
Yeah, we need that higher low. I can never say that I was lucky enough to get in here.
Yeah, nobody can.
Nobody can. And somebody who claims to be is probably
They
God.
lost a ton of money on the way down, right? So they happen to be around off the bottom because they were losing before that, right?
Nobody
So
can
anybody who claims they were there were losing money weeks before that.
Yeah.
And they just happen to be around, continually losing money off the bottom. That's the only way.
It has to come here, hold here, go up, come back here again. And that's the time you can enter.
Exactly. Off that higher low. We're all looking for that confirmed higher low.
Yes. Yes. And then at that time, even if it goes sideways, it's fine.
It's fine. Anything is fine because we have a foundation at that point. It becomes easier to play. It becomes very challenging to get involved when we keep breaking lower lows. So when we finally have some kind of base underneath us, you could build a house on top of it. You know? It's a foundation you could build upon. We're just waiting for where that foundation
or maybe it's probably trying to make a inverse head and shoulders on the week.
Yep.
It's still, the current weekly candle is still slightly higher than the previous one. It looks like a bearish piercing, but who knows what the market will do.
I'll show you something interesting on my chart.
Sure, let me stop sharing.
One thing that has held pretty well, I think, on the daily is this previous. See, I have some box lines here. So I drew this box line with this candle in mind. This was May 20th. This was the low for so many weeks until the Fed broke it, right?
Yep.
So this is in everybody's mind. Like, this is what we lived with until the Fed crushed it. This is the Fed right here.
Mm-hmm.
This is the last Fed, right? The last Fed meeting was right here. So the Fed destroyed it in 3 candles, 3 daily candles. But this was the low everybody was hoping for. So I thought this was a very important line to draw. Now, interestingly, if you look at what happened recently, every time intraday we went under that, there were buyers.
Yeah.
So this is still an area of demand. Even here, we only kind of V-bottomed off of underneath that zone. We V-bottomed.
I'm not sure Think or Sim has that thing or not, but I'll show you the buyers on my.
This is definitely held up as an area of demand right here, underneath that old high. Underneath the old all-time low, kind of May 20th low, previous to the Fed breaking it.
Let me show you the buyers and sellers volume. I'm not sure how to do that in Think or Sim.
Let me stop sharing. Hold on. Okay, go ahead.
I did it.
I think that May 20th is something to look for. I feel like overnight we sell under that, but then we capture it as the big boys come in the morning. Particularly after Europe stops.
So if you were looking at the daily chart, if I just go and check out this, and you're looking at what candle was that? 20th of May, right?
May 20th. Yeah, that was the old low. That was the old low before the Fed crushed it.
Now notice, I just did a volume profile. Yellow is the sellers, blue is the buyers. From May 20 all the way until Friday.
So sellers are still in control on the volume, right?
Yeah, so the baseline is this red line. Let me get rid of this box so that you can. So the baseline is the red line. That being said, as we go lower, you find only buyers, very few sellers.
There you go. Yeah, that's very interesting,
You
Danish.
see that?
Yeah, that's very interesting.
There
Down
are
there,
no sellers here. Can you see? There are no sellers here. There are only buyers, bag holders. Here, buyers and sellers are in equilibrium. And as we go here, we have a lot of buying volume.
yeah, that's value right down here.
So this, if I were to extend this to just 1 day prior, notice this becomes like a B pattern.
Yep. Yep.
And there is a lot of buying happening here because you see a lot of blue bars like histogram.
Yeah.
More than 50% of the volume is from buyers.
Yeah. There you go.
Now, if I were to go before this day, okay? And that's what kind of gives me
that's the downtrend right there. See,
the
this is a
hope.
box. You could say before this was downtrend, and
Yes,
then it became
yes,
a box.
yes.
Then it became a box.
That's what
I'm
gives
seeing
me the hope.
now. Yeah.
That's what gives me hope because until now, it is all yellow,
all,
and
all downtrend line.
There are very few buyers and major selling happening at all the levels.
You could say that downtrend line broke and we went into a sideways box after that.
Yes. So if I were to draw this again,
draw one downtrend line off the top of those candles and then say we're in a box.
I'll show you an automatic. I'll show you something cool.
Yeah.
So you see the steps.
Yep.
See, the baseline was here, the major price action control line.
Yep.
And suddenly it got higher.
Yep, it did.
Now, if I were to arbitrarily just put my mouse cursor right here at this previous red line, this acts as support and resistance in itself. Here.
Interestingly, that second red line, as soon as we cracked it, is when we got the big belt holds underneath. We got the major percentage, absolute moves down, big red candles down after we broke the red line.
Yeah.
The second red line. Yeah. The Fed broke it right there.
Right?
Yeah.
This is an interesting tool, right?
Yeah, I like it because it kind of shows where value might be.
And you can even see that on a smaller time granularity. Like you can look at it by hours, like what hour, what happened.
Yep.
Look at that.
So I have some levels here. If you scroll to the right. So I'd say that's a critical level right there, that red line. Yeah, that red line on your volume profile.
Yes, it is a critical level.
That's a Fed line, I'd say. That's a Fed line right there. That red line, that's the Fed. So if we can retake that line, then we have acted, yeah. What is that? 12.6, right?
12.6.
If we can get back to 12.6, that means the Fed kind of never happened in June, in May. Was it June meeting? June meeting. Yeah. The June meeting never was a real surprise. It just was a fake out of everybody overreacting to what the market already knew. And so that would mean like the Fed never happened in June, right?
Yeah.
That is even if we melt up to that line, it means the Fed never happened. So I think that's definitely a critical level. And we're extremely close to penetrating again the May 20 low.
Oh, May 20 low is right around the corner. May 20 low was 11,689 and current close is 11,611.
Yeah, there you go.
So we are
very close to that, right?
Less than 80 points away. Less than 80 points on NASDAQ.
And we've already broken the record low after that, right? What was that? Not that one, the other one. The one after May 20th was
This is the one, 16th of June.
that's the low. But there was one before that, which I would call a shoulder. Go back.
Oh, you mean
Yeah. That little wick. Yeah. The shadow before that. Yeah, that one.
this one? Yeah, we have already broken that.
Oh, that's May
Totally.
20th. That's May 20th. Okay, so we've already broken
11,491. We have already broken that. 11,491. We are already above that.
Okay, where are we now? What's
11,600, 611. So we are 120 points above that.
Okay, yeah. See, so we've already cracked that. So the next bogey
And
is.
if you notice, this is something I learned from Dr. Rana. These dojis line up with the wicks on the left hand side.
Yeah, so the old support is now forming new resistance.
New resistance. Look at how beautifully this doji lines up with this candle's wick.
Yep.
And similarly, this doji lines up with this candle's wick.
And another thing, this green breakout of this line, this kind of separating line, this old support, new resistance, hold your mouse on the green that cracked it just like 5 days ago. Yeah,
this one?
Yeah, this 6 days ago. Yeah. So that was the first time we got, one of the first times we got indication on economic releases that inflation was coming down. Or consumer sentiment was coming down. So bad news was becoming good news finally, because bad news is what we desperately need to kill inflation. So that green bar was, digesting the fact that bad news is coming in. That big green bar. So the more bad news we can get, the more these green bars
so
should be
counterintuitive.
Yeah, exactly. Because the biggest fight is inflation. It's not recession. It's not slowdown. Recessions are temporary. Economic slowdowns are temporary. Inflation, your entire life, my entire life, because I was born in the mid-70s, has killed our purchasing power exponentially.
Yeah.
So everybody becomes poor over time with inflation. Economic recessions are just a year or two, a couple of months.
Yeah.
They're like a snapshot in time. But inflation is forever. It was your entire life, and I've lived half a century almost, and it's been my entire life.
It's dead by 1,000 cuts.
My dad bought a house in East Brunswick for $59,000 in 1978.
Wow.
Now it's 10 times that price. 10 times that. Over $500,000 easily. And this is my lifetime, basically. My entire lifetime. It's gone up 10 times. So the worry is not recession. And Powell is trying to tell the world that. He's trying to tell everyone the worry is permanent inflation. Because everything you make, all your income, all your assets that you generate returns off of, won't mean anything if we have permanent inflation. It will never be able to buy anything meaningful, because you will just get it eaten up by price increases.
Yeah.
No matter how much money you have, it won't matter, because you're always losing purchasing power.
Something that happened in Zimbabwe.
Exactly. And most of the emerging markets. So it creates poverty, over time. So he needs to do what he needs to do. Keep us in a flat market. Kill the labor market tremendously if he can. I mean, this is entrenched. I read an article saying pilots that drive 787, that fly 787s, large jumbo jets, they're going to get paid $425,000 by one of these airlines because we have a shortage of pilots. So Fed's got a really big problem on its hands. It cannot kill the increase in price of wages in supply constrained industries. And you and I have for a long time been saying that the baby boomers are all, disappearing, either from the workforce, retiring, or dying. that's creating a permanent supply crunch or availability of labor for critical industries. So the Fed has a very blunt instrument in Fed cannot generate demographics.
Yep.
There are two tools, right? One is monetary policy, the other is fiscal policy. Fiscal policy is supposed to get creative in addressing the fact that we don't have enough people to solve this critical supply crunch. Right? Another way of looking at it is you and I spent our entire lives in a demand-driven world. Demand always drove the markets. Demand drove the economy. Growth in demand globally from the emerging markets, middle class expanding, always was a growth demand story. Two major themes for demand for our whole life. One is the baby boomers getting wealthier and older. And number two was emerging markets, expanding the global middle class, more purchasing power globally. Now, for the rest of our life, we will have demand going down globally because all baby boomers are those two trends will flip the switch. And I'm glad you're recording it because sometimes I just think of these on the fly, but
I know.
I get more elegant about it. I had a rough view of it before we had this call. So I'm going to just flip the switch and turn the signs opposite on those two mega trends. So baby boomers are disappearing in those three ways I said they disappear. And the emerging markets, expanding middle class, is still going to expand, but at a slower pace. Number one, emerging markets demographics, emerging markets baby boomers. Number two, when you become bigger, it's the law of large numbers. You can't grow as fast when your economy has an expanded middle class already.
Law of diminishing returns.
Long diminishing return. You are getting closer to becoming a mature economy, which by definition has always meant in the lazy way economies work, you slow down. People have less kids and you can't grow as much because you have a bigger base. So that will be a supply-driven world because supply will drive everything. Supply will drive price. Supply will drive price of the markets. Supply will drive inflation. Inventory needs to be managed in a way, inventory, not goods only, but services too. Because 70% of America's GDP, we know, is services. Right? So how will global supply of services match the adjusted declining demand will be the story. And that's why Powell is having such a hard time, because he spent his entire career in a world where demand drove inflation and the Fed could handle that. Now, overnight, after the pandemic, or the pandemic was the catalyst, but it was all in the works, headed there as we boxed in for 2 years at a time before digesting the fact that supply now, we're shifting to supply driving inflation, and the Fed needs to, lean on, as Powell was trying to do during the pandemic, lean on fiscal. Powell said, it's not just me printing money. We need fiscal side to step in, and they did big time, right? That helped. But we need the fiscal side to get creative now too. And we definitely don't have that leadership. I'm not going to get into politics. We need creative solutions on the fiscal side, like immigration opening up, like technology being incentivized, right? Like we incentivized renewables in the West, right? And it worked. We have a ton of renewables on the grid. But we need to incentivize supply chain technology being, risk being taken in that area. We need, we need data, we need automation, we need to see transparency in, where the mismatches of supply and demand. We need to move people around easier. We need to be able to work for other countries in an easier way, all of us. The emerging markets for developed markets for emerging markets, both ways. Service each other more freely. all those things would help us manage this mismatch that we have between supply and demand, and the fact that we're switching to a demand constrained world, and how do we adjust supply
I have
to that?
seen that. So on that note, like I moved here 3 years ago in Australia, and I have seen this happen very proactively in this country. How they regulate the number of people coming in, like the immigrants, and they regulate the demand side of the market very, very efficiently. The pandemic threw a wrench into the machine, and the influx of people was affected because of that. But on your point that you just mentioned, this is one of the very good ways of keeping the market hungry. More mouths to feed, more mouths to make taxes, more mouths to buy houses, buy cars. So the supply side problem happens because we are stuck in a box or a compartment. I do not want you to come here. I can give you the stuff in your house, in your box, but you are not allowed to come here. So the free movement of people and resources makes one of those things very efficient, that the engine keeps going on. The economic engine keeps going on. I mean, New York City is the perfect example of that, right?
Yep.
Constant influx of people, no matter what, come what may, New York will always have influx.
Yep.
So probably that's the only thing that we need to bring in more people, to bring in more demand.
And one of the virtual ways to do that, because you're involved in technology, so am I.
Yes, technology.
Allow people, like if you look at the IT industry, they've largely done that as a bellwether. When there's not enough people to work in a country, we offshore.
Yes.
Right.
Yes.
Yeah. So it's like they're virtually working in your country.
Now all the jobs are remote, right?
Yeah, exactly. Remote within a country, but then also remote offshore.
Yeah.
You have your offshore teams too. Right?
They don't bring in people
call
anymore.
Centers, and now it's for data analytics. It's for enterprise software. It's for all these other. It's for consulting. I just went down to Costa Rica, and I said, "Who are the people who work in IT?" They said they're all like Infosys and McKinsey. So all offshoring, right? Offshoring the consulting IT services, offshoring the IT services themselves. So it's tremendous. So we need those kind of creative solutions from the fiscal side to open that up, and that will help match supply of goods and services with the declining demand growth. So interestingly, what people don't realize, and they're not hearing in the press, is that this problem solves itself because we should have a permanent oversupply of everything if we're not matching supply with demand, which we haven't been doing for decades. So all of this growth will oversupply. And we all saw the Target headlines. I'll give you two big headlines that I read. One is Target is complaining they have over inventory. This second one is phenomenal. I'm sure more of it will come up. The big guys are talking about the big box retailers, as they call them, Walmart's, Targets of the world, are talking about saying that when you return something, did you read that article on returns?
No.
You'll love this then. It's new for you. When you return something and you want a refund, they're going to give you the refund, but guess what? You don't have to give it back. You get to keep it.
Because the cost of disposing it off is again an added cost. You want your money? Fine, take your money and leave us be.
Leave us alone. We don't want to lose more money.
Yeah.
By taking it back.
Yeah, you
spend
$10, you take back your $10, but we don't want to spend another $5 to dispose of those $10.
There's no people to process that whole thing back into the system.
I hear you.
Isn't that crazy? But that's a great sign that We are over inventoried already.
Yeah.
Already over inventoried. We already
Yeah,
have too much.
I read about that for Amazon specifically, that 90% of the returns go into landfill.
They're doing it quietly, obviously, because they don't want everybody to say, I don't want this, even though I do, right?
Yeah, I hear
So
you.
trying to figure out how to do that. But that shows that, there's going to be, there's another article. They said the Midwest is going to become ghost towns in the US. Because when you're a small town, you can't support everybody. I heard this at an event. A guy was telling me he lives in a rather small town, and it becomes hard to come up with any kind of real services for that town. This is a town, I think, in the Northeast, right? And it only had a couple of thousand people. And he said, you want a fire department, you want a police department. It becomes very hard, because how do you support those salaries with so little tax dollars?
Yeah.
So we're going to have an oversupply of real estate in many areas. And then, that trickles down. Then you have an oversupply of services, oversupply of goods. So we're going to have a lot of too much of a lot of things. And that should help tamp down inflation. But the critical thing is, we'll probably live in a lot of boxed worlds. If you look at the 60s and 70s, largely boxed, boring times on the SPX.
Let me check it out.
And yeah, check it out. Check it out. Those are extremely boring times for the market, I believe, from memory. If you do the SPX, probably monthlies you want.
Monthlies?
It might be faster.
Yeah. Yeah, this was stagnation time.
There you go. Look how flat that looks in the grand scheme of things. You could zoom in, and so you're not cheating.
This is right here.
Yeah, look how big that
this
box
is mother of all boxes.
There you go. Start at the mid 60s.
Let me make that box for you.
Yeah, make that box. It's so obvious, right?
It's in your face box.
Yeah. Look how boring that time was to be in the
1963 to 1980s.
Yeah, till Reagan, right? Till Reagan, till Volcker, right? Till Volcker. Remember, you're cutting that box off at the end, right when Volcker killed inflation, right? 14% mortgage rates in America, right at the end of that box. So he had to throw us into a recession, but then he gave us 40 years of growth, Volcker.
Yeah.
Volcker's still alive?
What?
Volcker's still alive?
I don't know.
But he set off that breaking of the box. Volcker did. With two things did. Volcker and the fact that Reagan opened up the economy. Remember I said fiscal? So Reagan privatized. Reagan privatized the airline industry, privatized the natural gas industry. So fiscal side came in and monetary side, both working together.
Yeah.
We all still hear about the golden era of the 80s, right?
Yeah.
Both sides to break the box finally.
We need the same thing here again. And market is a perfectly efficient machine, so it'll automatically recalibrate. That's what I believe.
See, the 70s side was command and control by Nixon and the hyperinflation of Carter in the 70s part of that. Now, the 60s, I was not alive. So I didn't pay attention enough in history class, but I didn't live that, Korean War, a Vietnam War, Cold War, post World War II, Cold War era.
Yeah.
Right. Lyndon B. Johnson. JFK started this box, right? No, JFK died, was assassinated at the beginning of that box, right? And then LBJ took over, right? And then Ford, and then Nixon. Yeah. And then Carter crushed us. One-term president, Carter, which Biden is about to become. And that's what happens in these boxes, right? You don't last. So these guys were all presidents you never hear about after JFK up to Reagan. Anybody know a president from JFK to Reagan now? No.
I don't think so.
Yeah, because they gave us a freaking box. Right?
Yeah, you're right.
They kept us in the box and never really gave us a bunch of long wars that never got anywhere. fighting this imaginary Cold War against the same nemesis we have now, coincidentally, which is Russia, trying to bring back the old Soviet Union, which we were fighting during this time in the Cold War. This box was all Cold War. Cold War ended with Gorbachev in the mid-'80s, right?
Yeah.
And then finally Soviet Union dissolved in 91. But it ended, Gorbachev ended the Cold War in the mid-'80s, right? 86, I believe. So that's when we took off. So we're getting back into a Cold War box right now against China.
But if you look at it, Javed, I don't know if you can see because I can see it as clear as a day. On a month, we are looking at a inverse head and shoulder.
Yep. So we coiled, right? We coiled for the measured move from this, and then just kept going.
20 years.
Yeah, 20 years of box.
20 years. And let me see, what was the measured move? 53 points down. Oh my God. SPX was only 117 at that time. My God. It was a baby.
It was a baby. And remember, there was no inflation during this time, really. Meaningful.
Oh, 53. Right here.
Mid-'80s, right?
This is the top of this is the measured move. It hit here and then pulled back.
And then we kept going. And again, fiscal policy came in here too, Danish. So in the mid-'80s is when Reagan came up with this tax law, and they took those 401ks, right?
Yeah.
And lowered capital gains tax. And then we took off after that.
That's what is happening.
That was fiscal policy, not Fed policy. That was fiscal policy. But, we're asleep at the wheel on fiscal policy. I think Biden wants to give gas cards. I mean, that's borderline.
What's the price of gas nowadays? $5?
$5 in these fronts. So, gas cards, like rebate cards. I mean,
I know.
Seriously. In 2022, that's the most sophisticated answer that we have. Yeah.
I mean, I remember in 2014 or 15, I have purchased gas as low as $1.33.
Yeah, I remember the good days. Good old days. Back in Texas, when I started working, or Louisiana, when we were driving through to go to New Orleans, 80 cents in some places. We would joke that the gas station is a couple of 100 yards away from the refinery, which is a couple of 100 yards away from the actual oil field in Louisiana. So it's like you have no middleman here. 80 cents gap in the late 90s. So,
but I'm saying not even 10 years ago.
Yeah, even better.
10 years ago.
So we don't have fiscal, but when you start seeing fiscal combined with the monetary, then you see these trajectories take off and break boxes. But you need the fiscal to be in there. You need either like a mega trend like the internet, which was the mid-'90s, and Greenspan's surprise rate hike that everybody likes to talk about of 94. And then we had exponential growth after that on the chart, 1994. Broke the box until then. And then we got 20 years of growth with the internet, which is most of the NASDAQ 100.
Surprisingly, I did not realize one thing, Javed. I always used to consider this as double top. But
so you have a channel right there. You're drawing a channel. You could draw the bottom of that channel too.
But why would I consider this as double top when it was not a double top, or rather a double bottom?
There you go. So double bottom setting up for the measured move. Higher.
The way up.
And that new channel.
This new trend, big fat trend line.
This was 5 trillion. So if you see the bottom of that double bottom, right? Okay. And this, if you make this a channel, let's say up to the pandemic, the last 10 years, that was the Fed printing $5 trillion of liquidity. So if you go to like Fred Yeah, go ahead, draw it. And then go to the web again and go to Fred and type in like Fed balance sheet. Yeah. Who's got it? Total assets? Yeah, that's good. St. Louis Fed. Yeah, go there. And you'll see during that time period that you just drew, the Fed expanded the balance sheet by $5 trillion from the end of the financial crisis to the pandemic, from gray to gray, recession to recession. So zoom out again. Where's the grays?
Sorry. Yeah.
So from the heart of the 1 million to 6 million, right?
Yeah, 1 million. This is 1 million here. And
Brought it up to 5 trillion, right? Close to 5.
This is 9 million.
Total assets. Factors affecting reserve balances. Let me see. I thought it was 5 trillion expansion, but I could be wrong.
See, this is actually 8 trillion. No?
Yeah, now? Yeah, because during the pandemic, we doubled it, right?
Yeah.
We went from 4 to 8, right?
Yeah, it was 4 here. We went to 8 here. 9.
9. Even more than doubled. And it
9.
was 1 before the financial crisis went up.
And the thing is, you printed all that money and that money is appreciated.
Yeah.
You printed a truckload of money and now that money has appreciated.
Yeah, that's the crazy thing. So the dollar went through the roof.
Yeah. Right?
Back to parity, right? With the euro. So you printed money. That is reserve currency status. So why is America willing to put unlimited capital into Europe to
Unlike
defend
other
it?
parts of the world where the more you print, the less valuable you get.
Exactly.
This is pretty ironic.
All major goods and infrastructure is built on the back of USD. Commodity, trade, services, everything is denominated in USD. Well, all central banks are holding USD in their central bank vaults to back their local currencies.
So how about this? Remember
treasury.
about 3 years ago, you and I were discussing about liquidity of SPX versus NASDAQ.
Yep.
That how SPX is the most liquid instrument in the world.
Yep.
That being said, NASDAQ started 3 days a week after option expiration.
Yep.
And now, at that time, you and I said, if that day ever comes, SPX may probably have a daily expiration.
Yes.
And guess what?
No, don't. I didn't even know that.
Oh, you did not know that?
Oh, I didn't know it happened.
Oh, so they have introduced now they have introduced event-based expirations and daily expirations on SPX.
What does event-based mean?
If a Fed meeting is there or
event-based, you said. Sorry, I didn't hear you pronounce it. Event-based.
Event-based
and daily. They have
and
daily.
And daily. And weekly. And monthly. And quarterly.
Weekly, monthly, quarterly, great, because that's normal.
So
but
see.
Daily is revolutionary. See, this is innovation, right?
No. Daily so what I'm trying to get to is, just by the virtue of printing more dollars, they actually made dollar more liquid.
There you go.
Right?
Yeah. Yeah. Oh, yeah. So when I talk about supply demand, the answer to why, how does the dollar get printed and appreciate? And I was saying this in the heart of pandemic, and I think I'm on record with you saying this, is that I, from my 10 years of project finance experience, realized that there is way too much appetite and demand for those dollars globally. And the easiest way to think about that is, how many dollars does it take to build a country, build a young, emerging market, frontier market country? How many trillions of dollars will it take to build your roads, your bridges, your highways, your electricity, your water, your internet? Because this is the backbone of your country. This is one country or two or three. But we have endless number of countries that need this capital. I just came back from Central America. It looks very similar to what it used to look like when I went 20 years ago, except for a handful of new highways that don't seem very heavily trafficked and that aren't very wide at all. You know, maybe still 2 lanes, but just new highways, you know? So it takes decades to build a country up, is what I'm trying to get at, and trillions of dollars. So when we print a handful of trillions in the US alone, and we're the only guys really printing it, then it's not enough for the appetite of the world to absorb those dollars, to build their economies with. Now I'm just talking about physical infrastructure. You know?
Dollar is more the merrier, right? The more you print, the more liquid it becomes.
Yeah, because how does Flipkart operate in India? You know, it needs dollars, right? It needs liquidity, right? These mega multi-hundred-billion-dollar companies in other countries need liquidity, and they don't get that liquidity in their local currency because they need global liquidity currencies. The global capital markets are worth 117 trillion, I think, in the bond markets, you know, debt markets, and then another 100 trillion in the equity markets, right? So most of this is largely dollar denominated or dollar backed. So when your country needs liquidity, it goes back to the dollar because it's backed by, like, you know, somewhere around, you know, under 200 trillion of assets moving in the world every day. So this is very small printing compared to what is needed out there in terms of oxygen of economies. So
it has really become more liquid in the last 3 years.
Yeah, we needed the liquidity. That's how the markets grew in value. So I think that I'm happy with boxes as long as I don't need both ends of the box. I don't need to know the top of the box. But if I can find the bottom of it, then I'm happy to sell premium, collect yield the whole way through. No problem. I would love a box because when everybody is making money from buy and hold, we have an inflation problem. As we see now, prices don't stay where they are. I would rather make my money in the box while we're oversupplied in everything, because then I make from my assets in the market will buy more. Because the whole point of making the money is to buy something. So if I can buy more of everything, goods and services included, then that would be great. You know, I mean, how long does it take to develop a pilot? Some of these guys fought in the Vietnam War. I mean, most of our great pilots come from the military because they already had the war experience of flying. Then they flew smaller planes and then got to the big jets. It takes decades to build a good pilot. So this stuff doesn't get solved overnight. You can't outsource a pilot yet. You can't automate a pilot yet. There are 200 souls aboard, 300 souls aboard. You're not going to automate that anytime soon, even if it's technically possible. You still need somebody at the wheel. So, you know, have we automated the trucks yet? Not yet. Have we automated the ships yet? Not yet. You know, so when are we going to get there? Right? And when are we going to do the intermediate of help all these limited amount of bodies that we have do more with more data, with more software, with more hardware, so they can become the equivalent productivity of 10 people or 100 people. It's just taking a lot of time. Never have enough bodies. So it's going to take time, and I'm happy to take advantage of the box while we sort all
While
that.
that happens.
Yeah. So I'm okay with long-term boxes, 2-year boxes, whatever. I'm okay with it. No problem. I'm glad I have premium on my side to do that. Oh, one thing that was my biggest fear that I want to address, I've been talking about it with some people, which is probably coming our way. So I was really afraid of a world where we have a low VIX
Yeah.
and no upside in the market, right? Because we're very used to low VIX means market taking off up. Let's say low VIX and box, tight box. Now, I'll tell you why I'm okay with that. Because when the VIX is low, the box should be easy to see because there's so little vol. So by definition, structurally, it should be easier to find that box. That's when we have to get better as swing traders, as technical traders, because we need to live in that tight box and play it for all it's worth. So I'm not afraid of the fact I'm not collecting as much premium every day, every week, every month, because I will have a better sense of where that box is, so I can be more elegant about where I put my strikes and how much exposure I take at the bottoms and tops and middles of that box, and be more confident in it too. So I'm not afraid of that world. I just want to be able to have the right tools to play the scenario I live in. That's all. But that is my nightmare scenario. Everything else will give me a ton of premium, which makes collecting premium easier. That's my worst premium scenario, but it should make the other part of trading easier, which is identifying the box and how to fade it.
Once you identify the box, you can easily scalp.
Yeah. So if vol goes down, the box should become crystal clear, and you could scalp or swing around it.
Yeah. Using options or straight up.
Yeah, or both. And so even though you're collecting less in premium,
that's
you should
okay.
be able to juice your returns because you know how much premium to take and where.
Yeah.
Where to put your strikes, how much underlying exposure to take, and how much premium to collect. You'll have a better sense of that balance between the two. So combined, the underlying return plus the premium return should give you a healthy yield overall.
Yeah.
So I'm ready, hopefully, for all scenarios that come. Just getting a better sense of where the bottom is, and then I'll get more aggressive, which I think is similar to you, which we both did during the pandemic too.
Yeah. All right. So it's been a nice call. Nice talking to you.
Yep.
So the bottom line is we are probably headed for a U recovery.
Yep.
And
Until
this is going to be slow, but at least as of right now, this is not like falling the way it did here.
Yeah, I just don't see it. Yeah, I don't see that, because that was going into a 100-year flood, and we had no idea how deep the flood was going to get. We didn't know when we were going to get vaccines. We didn't know when economies were going to open up. The world was shutting down in operation.
Yeah.
So we don't have that now. We kind of have the opposite. Everybody's opening up. Even China, which has a zero COVID policy, is opening up as well.
Yep. All right, Javed, thank you for your time. Yeah. And we'll talk soon again.
All right. Sounds good.
All right. Thank you very much. Bye-bye.